Do you know how to calculate the prices on your goods and services? Do you know how the market establishes prices? This video is for you. In this video, we will consider the different approaches toward establishing a selling price for your goods and services. We will then look at how the free market establishes prices. And we will conclude by considering the implications of what the market is willing to pay for goods and services versus what we are able to pay. With that, let's dive into the presentation.
We start by looking at cost-based pricing. In this approach, we set our cost price for our goods and services as the reference point and set it at 100%. We then add a markup onto our cost price to establish a desired selling price. For example, if we can acquire goods and services at $500 and would like a 25% markup, our selling price will be $625. Next, we consider an alternative approach called sales-based pricing. In this approach, we set the selling price of our goods and services as the reference point and set it at 100%. We then deduct a desired gross profit percentage to arrive at our target cost price. For example, if we can sell goods and services at $625 and would like a 20% gross profit percentage, our desired cost price will be $500. Next, we contrast the two approaches against each other. We note that in both examples, our cost price is $500 and our selling price is $625. However, in cost-based pricing, we had a markup of 25%, which was relative to our cost price, while in sales-based pricing, we had a gross profit percentage of 20%. Which was relative to our selling price. It is important to note that gross profit is not the same as a markup. This is an important foundational concept. In our income statement, the starting point will be revenue, which is based on selling prices. We then deduct items which we analyze relative to our revenue. Sales less cost of sales is equal to gross profit, which is a fraction of our revenue. Our instincts will suggest that we use our cost price as a base and markup in order to cover our costs. However, this approach ignores what the market is willing to pay and whether or not we are actually creating value. We should instead use our selling price, which the market is willing to pay, as our base and work backwards to establish our desired cost price. In the free market, we have buyers who are always negotiating for the lowest price possible as they interact with sellers. In this way, they put downward pressure on prices. At the same time, in the free market, we have sellers who are always negotiating for the highest price possible as they interact with buyers. In this way, they put upward pressure on prices. When the buyers and sellers in the market reach agreement on a price, they establish a market price. This represents the agreed average price between all the buyers and all the sellers. In our previous example, the sales price or retail price represented the final market price. And we can see that a final market price of $625, which we are saying the market is willing to pay, implies a gross profit of $125 if we want to achieve a 20% gross profit, which in turn implies that our cost price will be $500. In other words, by working backwards from the sales price, our target gross profit percentage will establish the maximum cost that we can incur. Cost-based pricing is instinctive. Business owners will be tempted to use it to minimize their risk, but it is ineffective at establishing the viability of a product's selling price. On that basis, we can see that sales-based pricing is critical in understanding if our product has a viable price in the market. A higher gross profit percentage implies increased value being added in the market's opinion. They are willing to pay a premium over your cost because of the actual or perceived value creation. If we find that we cannot sell our product in the market at a price above our cost price, then we need to question whether there is truly a demand for our product or whether we are truly creating value for our customers. Passion for our product is not the same as market demand.
In this video, we learned about pricing. We started by considering two approaches toward pricing, namely cost-based pricing and sales-based pricing. We saw that cost-based pricing is something that comes instinctively to people because it is a risk-based approach whereby we try to cover our costs by pricing higher. However, we also learned that it is not us that establishes prices, but the market, based on supply and demand. Therefore, we need to consider the maximum price that the market is willing to pay for goods and services, and then work backwards in order to establish the cost price that we desire. From these lessons, we concluded that if we are not able to sell our goods and services above our cost price, it is because there is not a market demand for our goods or services, or alternatively, we are not creating enough value for our customers. Passion for our product is not the same as market demand.
If you enjoyed this content, please like the video, subscribe to our channel, and click on the notification bell. It helps us grow the channel and bring more content to small and medium business owners and managers. Also, be sure to check the description below for any related product affiliate links. And finally, please comment on the video or click on our community tab to further interactions and updates.